Hello and welcome to today's video. Hope you are doing great. We will be discussing today on IPO, Initial Public Offering. An IPO is a process through which a privately held company becomes a publicly traded company by selling its stock to general public for the first time. So there are generally two types in which company launches an IPO. One is the fresh issue and other is offer for sale, which is called as OFS. In a fresh issue, company will issue new shares and the money raised through this is received by company and utilized as per the objectives they mentioned while launching an IPO. Whereas in offer for sale, shares of existing promoters and investors of the company are sold. So now let's discuss why would the company decide to go public, and there are few reasons for that. First is to raise capital. By selling shares of the company to the public, company can raise capital that can be used to various purposes, such as expanding its business, paying off debts, or funding new projects. Second is to increase brand visibility. Going public can increase the visibility and credibility of the company, which can help attract new customers and partners. The third is to provide liquidity to the shareholders. Going public allows shareholders of the company to sell their shares on the stock market, providing them liquidity for their investment. These are shareholders who invested in the company in the initial stage of the company. Now let's discuss what are the steps involved in the IPO process. The IPO process in India is regulated by SEBI, Security and Exchange Board of India, and there are several steps involved in IPO process, which are: it starts with the preparation and the filing of the draft red herring prospectus, which is short formally called as DRHP, with SEBI. Documents include detailed financial and business information about the company, and it is used to determine the terms of IPO. Then there is the appointment of merchant bankers and other intermediaries, such as underwriter, legal counsel, and auditors. After this, review and approval of DRHP is done by SEBI. This can take several weeks or months depending upon the complexity of the IPO. Then, filing of red herring prospectus (RHP) with the SEBI and stock exchanges are done where the stocks will be listed. After this, marketing of the IPO is done to potential investors. This is typically done through a process called book building, where investors indicate their interest in the IPO and the price at which they are willing to buy the shares. Then, on the allotment day, shares are allotted to the successful bidders and listing of the shares is done on the stock exchange. As an investor, you may be wondering how can you participate in the IPO and what potential risks and rewards are. So here are the steps how you can take part in the IPO. First, you need to do research for the company. It's important to truly research the company before deciding to invest in the IPO. Look at its financial statement, business model, industry trends to get better understanding of its growth potential. Secondly, determine your investment goals. Consider your investment horizon, risk appetite when deciding to invest. IPOs are tend to be riskier than established companies as the financial performance of the company is often more uncertain. So once you are sure you want to invest, wait for the IPO to be announced. Keep an eye out for the announcement and terms and pricing of the IPO. Once the IPO is announced, you can place your order through broker or online platforms such as Grow, Zerodha. You can find the link to Grow in the description section. Keep in mind that IPO allocation process is a lottery process and there may be chances you don't get the allotment. So after allotment of the shares, suppose you get the shares. So now you have to choose to hold on to your shares for long term, sell them as soon as they start trading on the security exchange based upon the research and the motive behind investing in the IPO. In 2023, many IPOs are to be launched. A few of them are Snapdeal, Go Airlines, MobiKwik, and you can read other on the screen now. Now let us see what are few pros and cons of the IPO. Let's start with the pro. If the company performs well after going public, the value of shares may increase significantly, leading to the potential higher returns for the investor. Investing in an IPO may allow you to get in the ground floor of the Investing in an IPO can allow you to get on ground floor of a promising company and potential benefit from its growth over the long term. Adding an IPO to your portfolio can provide diversification and potentially reduce the overall risk of your investment. Now let's discuss what cons are. IPO tends to be riskier than the established company, as the financial performance of the newly public company is often more uncertain. There are also higher risks of fraud and mismanagement. The price of IPO may fluctuate significantly in the early days of trading, which can lead to potential losses to the investors. The information about an company before an IPO may be limited and making it harder for investors to make informed decisions with the investment. It may be harder to sell your shares in the IPO compared to the established company as the trading volume is less during the initial days. As you can see, an IPO is a complex and significant event for a company. It can provide many benefits, but it also comes with some risks and responsibilities. If you are considering investing in an IPO, It's important to do your research and consult with a financial advisor before making a decision. I hope you found this video helpful. Thanks for watching. Nikhil Dhawan signing off.